First I've already shared. In next 60 seconds, I'll just share one more question and then we can probably start action. I think another 10 seconds and then I'll end this poll. Request everybody who has not yet opted for the answer, please do it. Okay, thank you. The second question is about, have you used any AI tools for investing? Used directly or have probably, kind of heard anybody else doing it and then you have indirectly used it on the recommendations or the basis of someone else doing the research? Okay, 10 more seconds if in case you have still not answered. Okay, thanks. I'll share the response for this poll as well, because this is what, Akshay, you would have expected.
No, I'm a little surprised, but really useful information. So thank you everyone for answering.
I mean, see, I can understand why 6 people would have opted for not sure, because many times you don't know what's going on behind the scenes. This is where we have to come in for this kind of a session. 3 people, I am surprised, they are using investment research. But Akshay, honestly, this is as per my expectations. Might be,
Okay.
Be different, but with that note, Akshay, again, welcome, and stage is yours. So,
Vaibhav, thank you very much. Yeah. And I want to thank all the participants for joining and spending your hour with us. I know it's right in the middle of your evening, but it's a Tuesday, and I hope you'll enjoy it. So, Vaibhav, you're right. AI is very fashionable. And, 6 months ago, people used to sort of say, AI, oh, really, not again, how boring. With ChatGPT, suddenly the things have changed. AI is very hot. It's very fashionable. It's very, very much in conversation. I just had a newsletter from a law firm in London, of all places, writing an article on what is ChatGPT. So when lawyers start to take what is ChatGPT, then we have to take it seriously. Kuch to ho raha hai yahan par. Now, so that is one thing. So I will spend a little time on AI. Sure. It was very interesting for me to see that 75% of the people in this are, under 30 years old. So a lot of young people. There are 3 people who are over 50, and since I'm over 50, I want to say a special welcome to the over 50s. I'm glad to see you are still investing. But unlike you, Vaibhav, what was a surprise to me is that 80% of people on this call have not used AI tools before. Now, that is really interesting. So
I think, Akshay, what it might be, sorry to interrupt, but the question was, have you used AI tool for investing purposes?
For investing purposes. Yeah, that's true. That's
exactly.
true. I stand corrected. So for investing purposes, so let me tell you how I think of AI for purposes of investment. So, I don't know if some of you may not even remember. Think back on days before Google Maps was around. So उस समय हम लोग क्या करते थे? We had a paper map. Okay, and if we knew where we were going and we knew the route, then we went very easily. Okay? There was nothing to look, nothing to ask, nothing to go. But when you had a paper map, then you sort of looked at the map, And then you drove the car. You could obviously not look at the map and the road at the same time. So you probably had your friend or your wife or your partner, guiding you. And even then you made mistakes. Okay. So I think investing is a little bit like that. If you like in life, if you know the route to some place, you can go quickly. So if you know a stock or you know a sector and you've done your research, then there's no need of any tools. You should just go and invest there. If you have done your research, you have high conviction, you know the route, buy it or trade. It's when you don't know, which is most of us. It's a new route for us. Looking at it, AI, think of AI like like a Google Maps. It won't take you there. You still have to do work, so ghar baithe thodi pahunch jayenge. But it will make sure you make less mistakes. You could still make a mistake. Sometimes Google Maps put you in some crazy thing, which is either a one-way road or too small for a car. Ho jata hai kabhi kabhi. So even that makes mistakes. But it is much more reliable than having a paper map. So I think of AI in that way, that it is a guide. There's a lot of information and intelligence in Google Maps, but it is not always correct. And it is not a 100% foolproof method. Okay, most of the time it works, but when it doesn't work, it doesn't work. So it's a bit like that. So that is one thing I want to say about AI. The second thing I want to say about AI is, conventional wisdom in investing, started by gurus like Warren Buffett, is value investing. Identify good stocks, wait for their prices to drop, buy, and then forget about it for 20 years. Okay, buy and hold. It's a buy and hold strategy, which has served Mr. Buffett very well and his shareholders extremely well. Nothing wrong with that. Okay, now because what happened, the school of thought that said we must do value investing long term became so prominent and so powerful that they started saying that short term is noise. And if you're a real investor, focus on the long term. Short term ko chodo, kuch na kuch hota rehta hai. We don't know, we can't control it, we cannot understand it. Just focus on long term, you'll be fine. Now, again, nothing wrong with that. But what I have a disagreement with is short term is not noise. The reasons are different. The factors influencing short term price movements are different. The way to make money is different. But that does not make it noise. You cannot say one thing is very good and the second thing is useless. I think as an investor, there are things you can do in the long term using AI. There are things you can do in the short term. Short term particularly, because when you look at short term, there is so much volatility, there is so much movement, there is so much information. You don't have time to do research. Okay? And because you don't have time to do research, you have to then either depend on training or information or something like that, which a lot of people don't have. But these days with AI, you have your Google Maps for the short term. And that AI helps you distinguish between noise and what is really a pattern. And machines, my submission to you is that machines are far better at doing that than humans. Okay? So I think there is a role for AI in short-term investing, and there is a role for AI in long-term investing. The best example is our own, when I say our own, it's a portfolio created by InvestorAi, and it's available on the WealthDasket platform called Equity Rocket. We'll talk more about it, in the second part of the discussion. But Equity Rocket has delivered 52% in 2022, when the market delivered 4.7%. And Equity Rocket has no human intervention. It's a completely AI curated portfolio. So I think AI is a very powerful tool. It should be used like Google Maps with the same caution and restraint, but used well, it can make a big difference.
So actually, one thing which obviously I agree with you is because long term is one strategy which everybody should have: buy, hold, and timely exit. I would say, just don't buy and hold, but exit whenever you see the fundamentals are not doing great. And this is where I kind of tie it up with my fundamental analysis as well. But one thing I obviously would agree with you is that between this point and that point, which is the long term kind of the stock, which wherever it is reaching, there is a huge zigzag around, kind of market is going up and down. Why don't we make use of those dips and kind of sell it at highs or something like that, which obviously needs a little bit of a constant churning, rebalancing, but obviously that is worth the pain when your returns are like a 50 odd percent in a year when the market is just 4%. I think we should make all use of those. And one thing which I agree, my views would be when Mr. Buffett value investing thing, or value investing is still, obviously in the last 10 years we have seen value investing has not worked. In the last 1 or 2 years it has again come up, because momentum investing was the talk of the town and it was working well. But the point is that when Mr. Warren Buffett was doing all these studies, there was no technology available. Now every little bit of cash is higher than market cap and this and that, all those things can be just in 1 second or 5 seconds can be obtained through databases and technology. So everybody knows that. So that arbitrage is also gone, honestly. So I think the investing methods over the time has also changed a lot. So I think this is where, kind of AI also comes into picture to pick up the best stocks. So Akshay, next thing probably I would want to, kind of understand from you is that when we say that even if it is for a short term, why rely more on machines rather than, kind of other kind of analysis where humans can also sit and assume that we are talking about humans who are sitting in front of the screen for 6.5 hours every day and doing some research by the end of the day. But still, why should these guys be looking at machines in order to pick up these stocks?
So, Vaibhav, again, a good question. And you're right. When Warren Buffett started investing, technology was at a very different level. I think in the first instance, investors who made money on knowledge arbitrage. They knew things other people did not. Okay. Then as knowledge became, and insider trading became illegal and knowledge became more available, it became information and analytics arbitrage. If I had more information and I could analyze it better, then I could make more money than you can make. Okay. Today, there is so much information that you get buried in information. So it is, then it became, let's just call it attention arbitrage. If you could sit in front of the screen from 9 in the morning to 4 in the afternoon, then you could capture opportunities other people who went to the bathroom or went for lunch could not capture. But that is not really sustainable. How many people can do that? I know people who made good money doing that, and they found a job and they started working and they could only pay attention for 2 hours. And of course, you start losing money. And I think technology is beginning to create an answer. I mean, it's not a comparison, but SEBI given SEBI information is that 89% of people who day trade lose money.
Yeah. Okay.
If you go to angel broking, they will tell you that number is not 89%, it's 94%. So why do people keep coming back? They keep losing money, but they keep coming back. Now, but then if you analyze why do they lose money? They lose money either because they don't have the training. They don't understand charting patterns. They don't understand all the technical terminology, or they don't have access to research and information because you pay for a Bloomberg terminal is $30,000 a year. It's very expensive. People cannot afford that. Institutions can. But the most important thing was they did not have the time. Very few people have the discipline to sit in front of a screen and not take too many breaks from 9:15 in the morning when the market opens in India and 3:15 in the afternoon when the market closes. How many of us can do that? It's a very dull life, and after that, your head is kind of spinning. So people who do that do make money. But if you don't do that, then you don't. Now, machines can step in and do that. Machines can recognize patterns. Machines can generate recommendations. Machines can even actually do it for you. And when you start including bots with AI, then it becomes like a phenomenon, the example I gave of you're sitting in a self-driving car with Google Maps, So you don't know where to go, it actually takes you there. So that is where the technology is advancing. And I do think a lot of people will be able to benefit from that. Now, I want to sort of digress a little bit. Most people here are 30 years old or less. If I was 30 years old, and if I were to ask somebody, how should I think of my portfolio? I would say, think of your portfolio in 4 categories. The first category is long-term passive investment. And I would literally take 50% of my assets and just buy index funds with it. Why index funds? Because they are the cheapest way to invest. Okay, a mutual fund, 83% of mutual funds underperform the index. So even if you just buy the index, you're on the 83rd percentile, with no cost and no fees. So why not just buy the index? That is one. The second reason is, did you know that there are only 3 indices in the world which have beaten inflation consistently in the last 40 years? It's NASDAQ, S&P 500, and Nifty. Okay, so I would just buy these 3 indices, put 50% of money, and sit back for the next 40 years. Okay, and in India, we have got 14-15% compound return every year since 1991 when liberalization happened. So that is compound interest is the best investing tool you can find. So the power of compounding, you must use that, especially if you have time on your side. And if you're 30 years old, then you do have time on your side. Then I would take 30% of my portfolio and I would put it in long-term equity exposure, which is very actively managed. I would not bother with having a diversified portfolio of 100 stocks. I would have a very concentrated portfolio of 10, 12 stocks, the kind you see on the WealthBaskets, the kind we have on Equity Rocket. And the reason it is useful is because these are 30-day ideas generated by AI, which can be rebalanced every fortnight or every month. So at any time, you're holding the best recommendations that have come from the system. But it's long-term equity exposure because you're not exiting. You're just rebalancing. Okay, so that would be number 3. So 50% in index funds, 30% in long-term equity exposure that is actively managed, not by a fund manager, but by a machine, because then the costs are very different. The third category I would have is short-term opportunities. And, for those of you interested, please watch this space. In literally a few weeks from now, we will be launching a new product called intraday baskets. And that is really exactly what it says, intraday opportunities. And I think there is money to be made over there. And I would put maybe 25% of my assets there. So 50 in index fund, 30 here, 80, and 15% sort of in short-term opportunities. And the last 5%, I would keep for just crazy investments. NFTs, crypto, all the digital assets that are coming around. But I would never do more than 5%. I would maybe do 2-3%. Keep small exposure, see what is happening, be in the market, otherwise you will not learn. But don't put too much money in it because it is still a bit of a wild west, it's unregulated. So, be conservative. So if you think of your portfolio in that manner, then the question becomes, can AI help you in each category? And my answer is absolute yes.
So Akshay, that brings me to the core of the discussion today. So can you explain a little bit of the strategies or the tech which is running the engine behind the stock pickings and all? So if we can go a little bit deeper into, kind of AI tools and et cetera, that you might be using, it should be very good to
So let me try and explain it in slightly easy to understand way, because see, I'm not a AI expert. I am not even a technologist. But over the years, I have learned how to use technology in financial services and use AI in investments. We have a team who's really experts and very, very good at this technical thing. But so what do we do very simply? We get data on 4,600 stocks in the world every single day. Okay, so it comes in at about 3 in the morning or 3:30 in the morning. For each stock, we have 900 pieces of, we get about 700 pieces of information. Some are updated every day, some are updated once a week or as and when. Using this information, raw information, we convert them to 900 features, okay? And each feature has some correlation to the objective of the model. So if the objective of the model is that we are looking for stocks that will generate 3% in 30 days, then that is what the model is solving for. If the objective of the model is that we are looking for stocks that will generate a positive return, no matter how much, in the next 6 hours when the day trading day opens, then that becomes the objective of the model. Okay, so each model has a different purpose. But we then create 900 features. These have been computed by us. That is our intellectual capital and intellectual property. Each of these features is a computed or a technical thing that, and each of them has a correlation to the objective. Some are highly correlated, some are low correlation. We capture these correlations through a gray color. So think of a 30 by 30 box, where each cell, we have 30 rows and 30 columns, each square is a gray color. The intensity of the gray color denotes the strength of the correlation to the objective. So if everything is black, theoretically, it's not possible. It would mean that every feature has very high correlation, correlation of 1 to the objective. Now that of course never happens. So you get a mixed grayscale box, okay? And that is how we train our model. So think of the 30 by 30 box as an image. We have now trained the machine and then we look at which stocks have actually achieved that objective and what do those color patterns look like. In a sense, what we have done, we have taught the machine that what does this kind of a picture represent and what do winners look like. Okay, in a very different context, think of facial recognition. If you have a machine at an airport that is trained to recognize brown faces versus white faces, the more faces it sees, the better it gets. Okay. Similarly, once we train the machine to recognize that this pattern of 900 squares represents a win, and it is not just one pattern, 8, 20, 30 patterns that represent a win, then the machine knows how to identify winners. When we get daily data in, the first thing we do is convert all these things into grayscale image, and then we run image recognition, image matching program. This process is called computer vision. Okay, so we use computer vision to make a short list of stocks that are potential winners in that day. And then we have a number of deep learning and neural network methods that filter the short list down to a very much smaller list and that goes through some checks and controls, and that is what we publish for people to use. So that is how recommendations are generated. I know it's a slightly long and perhaps complicated answer, but I hope it gives you an idea of what the machine does and why it is simply not possible for a human to do it.
That's actually, kind of really, you can say something which a lot of us have not heard about, converting your things to an image and then running these objective kind of thing. But I'll take a couple of questions, Akshay, here, so Paras has actually asked, how reliable can AI be for investing? Have you done a little bit of maybe a win-loss rate or something like that?
Yes. So look, Paras, the way we do it, we backtest the model for at least 1 year, maybe longer. Now, backtest is, I'm a little cynical of backtesting, honestly, even though we do it, because I've never seen a backtest that is bad. Okay, because I ask you to create a P&L and you keep changing till the results come out how you want. That is what happens. When people do backtest, they keep tinkering around with the input to make sure the output is correct. The real thing is a live test. Okay, if you're not in live test situation, then it is meaningless. No, I'm sorry, it is not meaningless, but you must be skeptical about it. That is why I love what we have been able to do in partnership with Wealth Desk or Wealth Baskets with Equity Rocket. And if I may take a little bit of time, I want to share my screen with you and just show you what is possible. So this is a portfolio called Equity Rocket. You can go on the Wealth Desk platform and it's available. It has delivered very strong performance. Okay, this is real performance, Paras, from February 2022 to March 2023, 14 months. This is not back testing. This is not even real testing. This is real money, real people, real performance. And as you can see, 100 rupees invested in the market would have delivered 104 rupees or something like that, whereas I'm almost embarrassed to say the Equity Rocket number. But performance is not the only thing you should look at. You must look at consistency. For me personally, consistency is far more important than performance. I will accept smaller returns as long as they are more consistent, because compounding will take care of the volatility. So let me show you the consistency on Equity Rocket. And that's the last sort of slide I want to show on this. This is every month, month by month. The dark blue bar is the portfolio, and the light blue bar is the market. And it has been, or the benchmark, which is Nifty. And we have beaten Nifty, the benchmark, in 12 out of 14 months. And I have highlighted the 2 months where we did not beat the benchmark. Okay, so when you evaluate an investment proposition, don't just look at returns and get seduced by very high numbers. Look at volatility, look at Sharpe ratio, look at information ratio, look at consistency. These are very important things, because if you don't have these things, then you're in for a wild ride. It may work out well, it may not work out well. Okay, so I hope that helps and makes some sense.
So actually, one thing which I also had in mind, and Rahul Shah has also just asked, because obviously we have been you have been performing so well in the Equity Rocket portfolio returns wise, but how do you compare the risk vis-a-vis the the benchmark? So the risk would be a little higher than what probably the benchmark's risk is.
Probably, because remember the benchmark is 500 stocks.
Yeah.
This is 10 stocks, 12 stocks. So it's much more concentrated. Okay, so if you had a benchmark with 10 stocks, then you could compare apples for apples. But since we don't have that, we are sort of comparing as well as we can. And please do look at the volatility and because chances are a more concentrated portfolio will always be a little more volatile. And that is why I say that don't put all your money here. 50, remember my allocation, ideal allocation, 50% in index funds.
Yeah.
I can't say very safe, but relatively safe, relatively stable, and don't monkey around with the allocation. Just let it run. 30% in this kind of slightly concentrated equity where you'll get some of the upside. And the short term is really short term, like intraday, the product we're about to launch. That is where you can get very interesting returns. You can go in, you can go out, you can come in one day, go out the next day, go on holiday for a week, do nothing. It's very easy, and you can do everything on your mobile. So I think, you have to create a portfolio, not just in terms of allocations, but also in terms of risk and in terms of your own time. You can't spend time on everything every day. That's just not possible, because we all have real lives and, jobs and so on and so forth. Pure din baith ke investment thodi karenge. So we have to remember that also.
I think with that, you answered one question from Divyansh, who just asked, how should a 19-year-old build his portfolio? Like what amount of money should be allocated to equity?
I wish I was 19 years old and I had the money to invest.
So probably I want to answer Divyansh's question as well from my whatever kind of financial planning I actually involved into. Divyansh, see this the 50-35 or 30-15%, 5% allocation what Akshay just mentioned. If you are a 19-year-old, I would say you can kind of go a little bit more aggressive on your 15 and 30 percentage, because you have that time and the risk abilities. I'm assuming it is a lot of other conditions also are there, but obviously you can take those calls. Probably a 35% in a passive fund and probably a 50% elsewhere can be suggested. Akshay might agree or disagree, whatever. So yeah, so like I would also think about start investing at the age of 19. I started probably at 24, which I also think is quite early, but for 19, great, Divyansh, if you are at that stage and you're thinking about investing anyways. But Akshay, I think Nitin is also asking a very kind of interesting question, is that there are 600 to 700 pieces of daily information you were just mentioning about, which goes into your matrix. Not all obviously can be fundamental analysis things coming out, the matrix and all. So what's the almost a composition of different kind of?
Yeah, good question, Nitin. So what we do is we almost always create a subset of, let's say in Indian market, between large cap and mid cap, we don't go much below that. Let's say there are 700-800 stocks. Yeah, we use fundamental analysis and fundamental factors to create a subset. And in our case, subset, it tends to be around 100, 150, 150 ke aspas. Okay. And then depending on the time horizon the model is looking at, either it's looking at 30 days, 15 days, 1 day, then we apply the technical factors. But we only apply the technical factors to the shortlist that has been created by fundamental factors. So you get a combination of fundamental and technical, but you get a two-tier process. Yeah. So that's how it works.
Great. So one question from my side, Akshay, is that how do you see this, kind of investment world getting disrupted further by artificial intelligence? So we have just started doing it, and you are one of the very few actually the funds which I know has been using AI in order to pick up stocks. But what's the future like? What do you think? Chat GPT-4 has been changing, kind of the world, which is outside investments, obviously. But next 5 years, what will happen? What may happen?
Yeah. So a good question. I think I'm going to answer it with a slightly longer term view. But first of all, I want to pick up your Chat GPT point. So see, what is Chat GPT? Okay, it is, somebody gave me a very good explanation. She said, the way to think about Chat GPT, let us assume you had a very smart 20-year-old boy or girl, human, who had incredible memory and incredible recall, who had somehow read everything there is to read on internet, okay, and has the ability to listen to you and filter out what is it that you're asking, okay? That is what it is. So if the information is not there, ChatGPT cannot generate it, even though it is called generative pre-trained transformer. That is what GPT stands for. It generates the answer. It doesn't generate information. So that is the mistake people made, that ChatGPT is going to take over the world and everything. No, that is not it at all. So in the investments world, can it inform you about companies and help you with your research? Absolutely. Can it tell you what you should invest in? Never. No, I will not say never, but not now. Okay. Can it tell you how to invest and how to make money? No. So it is not a substitute for judgment and things like that. So that is sort of one important thing to remember. But coming to your second question, which is more profound, as to what will happen in the next 5 years, 10 years, 20. I sort of spent many years running the global Barclays wealth and investments business. Okay, basically Barclays private bank, we were 8th or 9th in the world, and I ran the whole thing, out of London. My view is that the wealth management world will divide into 3 segments in the next 10 years. The first is private banking, which is ultra high net worth, very sophisticated, very tailored and all that. And there is a place for that. And there are a set of customers for that. They don't want anything else. They want that kind of service. And it's not service, it's the products. So for instance, I am an entrepreneur. I have 40% shareholding in my company, which I don't want to sell, but I want to raise money. Who will give me a loan against shares? With is that kind of very specialized work. So that's the first segment. The second segment is what we understand wealth management today, where we go to wealth advisors, we go to banks, and we go to HDFC Bank and Kotak Bank and ICICI Bank, and basically all those people do is sell us mutual funds. Why do they sell mutual funds and not other things? Because they get paid by mutual funds. Okay, so jahan fees milta hai, wo sab recommend karte hain. So there is an inherent conflict in that model. But it is an easy model. If I don't want to pay any attention, I just want some advice, I'll call an advisor. He or she talks to me very nicely. I have faith and trust in the individual. And then I make some investments. And generally, because India's economy has been going very well, I do well, I'm happy. Okay, there is always a place for that advice-led model. That is what I call it. But there is a new model emerging. And that is led by all of you who are 30 and under or 40 and under, or all of you who are very digital investors. And that is what I call the DIY model, the do-it-yourself model. This model came to in its own during lockdown. And it wasn't just India where people went directly to the markets and Zerodha grew and Upstocks and Grow and 5paisa and all the discount brokers grew. It happened in US, Robinhood, Charles Schwab, Fidelity. It happened in UK, Hargreaves Lansdowne, Interactive Investors, and so on and so forth. So it's a global phenomenon. This model is still forming. My belief that this model, what does it need? My view is it needs 100% digital experience on a mobile device. It cannot be half here, half advisor, half email, half something else. It must be 100% digital on a mobile device. Number two, it must never try to give you advice. It must simply help you what you want to do. Okay, if you want advice, go to the second model. Okay, but I believe a lot of people don't really want advice, partly because they don't want to pay for it. Secondly, they don't want to trust, they don't trust banks and institutions. They trust friends and communities and so on and so forth. So it must not be based on advice. Thirdly, it must use technology in a way that enables an individual to do what they want to do. So it must be empowering technology rather than restrictive technology. You can't do this, you can't do that, and this is very expensive, and you don't have enough money for this. All that nonsense has to disappear. It must be intensely democratic. I must be able to invest in anything I want, no matter how complicated. And let me decide the risk. No, I will read up, I will ask friends, and I'll find out. Don't give me gyan. Okay. And the final part of this is it must be affordable. My view, personal view on affordability, in my company do not want to produce any product that has pricing linked to assets under management. How much you invest has nothing to do with my technology. You're using my technology, pay me for use of technology, and you invest 10 crores, 1 crore, 1 lakh, I don't care. And I don't want to charge more than $1 a day, regardless of how much you invest. That is my model. It's a bottom of the pyramids model. But I think we are one company doing it. We are probably the first company coming out with ideas like this. But others will follow. If we are successful, others will follow. If we are not successful, then people will ignore us and move on. I hope other people come, because that will make this market more sophisticated.
So Akshay, actually, I've got just one direct question to me. Probably you can't see it, but this is linked to what you just said. If others are also coming in, and I have a kind of a clue in my mind, but I want to hear it from you. So it's asked that if suppose everybody starts using ChatGPT or AI tools for investing in the near future, won't everybody end up with the same conclusion or results for stock selections?
See, that's a slightly facile assumption. You're using that everybody's AI comes up with the same recommendation. That is actually not possible.
Because parameters can be different.
कल को आप spreadsheet बना रहे हो, मैं spreadsheet बना रहा हूँ, I can guarantee you both will be slightly different. We may use different fonts, the colors will be different, the column sizes will be different, the ordering will be different, the formulas may be slightly different. So, AI is not equal to AI. That's one thing I would say. Secondly, there is a issue. And I think GameStop, for those of you who remember lockdown days, actually is a very good example. What happened was, there was a social media buzz around GameStop. Everybody started buying GameStop. We junk company. But price went up like 200 times. So, yes, group collective behavior, if it happens all at the same time, can drive this. And DIY investing has that danger. So you have to watch for it. I'll give you an example. Our intraday product that we are about to launch, we come up with 4 baskets, recommended baskets during the day, and and 4 times during the day. But at any time, if one of the stocks pricing goes crazy, we immediately replace it. So what we're trying to say is that if you buy at 10:30 and I buy at 10:35, chances are you and I are getting a slightly different basket. Okay, and I think that is, again, humanly very hard to do, but through machines, very easy to do. So in an odd, perverse, counterintuitive way, AI and technology actually reduces the risk of everyone doing the same thing. It, of course, does not remove the risk of, a wave like GameStop happening or something like that. So there are pluses and minuses.
So Paras is again asked just on the GameStop thing, that what have you or company like InvestorAi actually, does to not get trapped in situations like that? I mean, what's their risk management probably in these kind of scenarios?
So Paras, I think, of course, we haven't done it, but my guess is that GameStop would never make it past our fundamental screen. Okay, because the fundamentals of the company are just not that good. It's a video game rental company. Who rents video games these days? So it would never have made it past a fundamental screen. But this is not to say that some stock that has made it. But that is why market circuit breakers are there.
Yeah.
So AI cannot solve every single problem. We have tried. See, the other thing you must remember. AI is a Formula One car, and I like using car analogies. Okay, when you're going on and on at very high speed, every few laps it has to stop and get tire changed. Okay, it has to pit stop and do whatever. If it doesn't do that, cannot keep going at the same level of efficiency. AI algorithms are exactly like that. In our case, every 3 to 6 months, we actually retune the algos based on what we have learned, based on market conditions, based on whatever we have, our own this thing. And then we re-release them. Because if we don't do that, performance starts to decay.
Yeah.
So, it's not that ek baar bana liya, hamesha chalta rahega. Bhul gaye to fir nahi chalega.
This is where machine learning as a concept comes in. You keep learning the machine.
Yeah, it's machine learning, not just machine keeping on going.
I'll take a couple of more questions as we are drawing closer to 9 p.m. as well. So Sri Kumar Ravindran has asked that, can you throw some light on how the model balances weights between fundamental and technical and other factors, for example?
Sri Kumar, that's a very difficult answer to give you in the time that we have. Because now you're getting into really the mechanics of how we do it. But suffice it to say, for now, it depends on what the objective of the model is. If it's a short-term objective, then in the first filter, which is creating the sub-universe, fundamental factors have a much higher weightage. In the stock selection process, which is the second step, technical factors have a much stronger weightage because our focus is shorter term.
Okay. Akshay, just a little bit of much technical question over here from Tanmay. I don't know whether you want to take this or not, but why computer vision is preferred over time series models like LSTM, which is long short-term memories, I can recollect, or neural net?
Very simply, Tanmay, we have tried LSTM, we have tried RNNs, but we found, and all the other things and several things that you have not mentioned here. We just find that the outcome is much better using computer vision. That is one reason. So it is a better model. Secondly, it is much better for real time. And there's a reason. All the models, other models are based on computation of variables. With computer vision, you're doing image matching. There is no computation involved. It's just recognition. It's much faster. So it's much quicker. It's much cheaper on cloud cost and cloud time. And therefore, we can deliver the result in a much faster manner. So, and we only came to this after 2-3 years of doing other things. And it's only when we tried and we found it. So now we are kind of, we kind of like this. Is this the one that we will stay with forever? Who knows? Maybe something better will come along.
Sure. So with that, one last question, which actually a lot of people have asked is, how can someone start learning about this? How can someone start, kind of do it yourself? I mean, not like getting into equity rockets, but like applying the AI mechanisms to any learning resource.
Before that, Vaibhav, I want to take one question that I can see on the screen, which is from Amog Masood.
Okay, algo trading. Sorry.
Any views on algo trading? Now, Amog, AI is not algo trading, boss. Okay, at least the way we use it, or maybe. So people, you think AI is algo trading? That is not right. Algo trading is when the trade happens automatically with no human intervention. The way we think of AI, the job of AI is to give you a recommendation. It is up to you to decide whether you wish to buy or not. Okay, so we are not removing the human. We are augmenting the human. Think of us as the Iron Man suit. If you wear the Iron Man suit, you can fly. But if the man is not there, suit will not fly by itself. Now, it will in Iron Man 3, but let's ignore Iron Man 3. Okay, but then he creates many suits which fly on their own, which, of course, but let's just stick with Iron Man 1, which I thought was the best film on the lot. So algo trading is where algo is doing things itself. We are not doing things ourselves. Now, just remind me your question once again.
So a lot of people have asked Akshaya is that
how do you get started?
How do you get started to learn about it?
Okay, so the first thing you do, look, you need some mathematical background. Now, if you don't understand maths and if you're one of those people who say, I hate maths, then chances are you won't like this. Personally, I did advanced maths in school. I did mathematics in university. I did statistics in university. So I'm not a computer engineer, but because my old statistics, is so useful. It's actually the most important things, statistics courses to help you understand what is going on. So that is one is basic knowledge. If you don't have it, between Udemy and Coursera, you'll find plenty of courses. So please invest the time and the discipline to learn that. Secondly, you have to do something. You can't just read about it and think you understand. I would recommend you to join a company that is working in AI and they're always looking for people. We are always looking for good people. So, I'm not saying come and join us. Please do if you want, but you don't have to. There are many companies. Please go work with Vaibhav. He has all the experience and you will learn a lot. Work with people you can learn from. Okay, that is how you learn. And lastly, I will say, make mistakes. If you don't make mistakes, you will not learn. So I would encourage you to go and fail. I would encourage you to go and make mistakes because that is the best teacher you can find.
Yeah. Thanks, Akshaya, for taking all the questions, guys. See, if you are, we spoke about equity rockets. I would just want to quickly show you in case, you would want to invest into that. Link has been shared, but if you can just, look at my screen, you just need to go to investorai.wealthbasket.in, which is obviously the link shared over there. And it's very easy. You just need to scroll down. There are multiple wealth baskets offered by InvestorAi. But if you are only looking at, equity rockets, because if the performance has been, great over there, even you see the day from which it became live, which is 14 January 2022 on our platform, it is still outperformed the Nifty 500 by almost around 43-44%. That's the alpha. It's very simple. Minimum ticket size is 2 lakh if you want to subscribe, and the fees is 10,000, almost 10,000 rupees per year. But you can go to any amount. I mean, 2 lakh, 20 lakh, 10 lakh, whatever you see. Like Akshay mentioned that he doesn't care about, kind of linking the fees with the as the value, the investment value. So minimum starts at 2 lakh, but you can go up to as much value as you can. Once you kind of put in this value and click on subscribe to invest, there are a couple of clicks which will happen, and then you are through. So it's that simple. I mean, you can just try it in the market as there's a list of brokers, kind of what we have, including Zerodha's, Upstocks, and other brokers as well. So there's a whole list of 25 or 30 odd brokers which we have. If your broker is there, I'm sure that it's a matter of 5 minutes where you are logging in. I'll just give you a little bit of a brief as well, that how are you probably going to get the rebalances. So whenever kind of the machine actually rebalances and does some changes in the stocks buying and selling, you will get an email notification, and you get multiple notifications. Of course, the execution has to be done by you. It is not like a mutual fund where everything is happening, and kind of, and you're not even aware. I would rather suggest, kind of, you guys who are interested into this and you have come in the evening to attend this session to learn more about that, you should be on top of the investments, what kind of it's in the portfolio. In the mutual fund, you never know which are the top 2, top 3 stocks. In fact, that was also what it's not that but here all the stocks will reside in your demat account, so that you have a visibility of what all stocks you are kind of currently holding. So whenever rebalancing is triggered, you will get an email. Click on the link. There will be kind of couple of steps, 2-3 link. Thing is done. So this is how simple it is, and you can just enjoy kind of returns what they have promised. Just a little bit of caveat: what this returns currently, what you saw or what Akshay mentioned, are actually pre kind of fees and pre the transaction costs. So that might be again 1-3% depending upon the investment amount, but still it's great. I mean, 40% alpha is super, with no promises that it can be kind of consistently generated, but you can see the historical returns and take your own decisions. With that, Akshay, we'll take one last question which Rahul has asked, and then we'll stop. What can be the maximum drawdown in short 2-3 months period? See, Rahul, nobody can tell what can be the maximum drawdown, but from the historical data, what is the number which probably you have, Akshay, for that?
Yeah, I don't have the number handy at the moment, Rahul, but I think there is a way to think about drawdown. See, drawdown is many things. You can be up 1% and lose 3%, and be minus 3%, your drawdown is 4%. You could be up 40%, go down 5%, be at 35%, drawdown is 5%. So drawdown alone does not tell you what is going on. It is one of the very important variables in your analysis. So like I said, look at drawdown, look at variables for consistency. Sharp ratio is a good risk-adjusted measure. Information ratio you should look at. Volatility against the market is another one. And of course, returns and, how many months have you lost money versus how many months you made money? What is the chart that I showed you on Equity Rocket? So it's not just one number that should make your decision. There are many of these.
Okay, guys, before we kind of stop and complete, we have again 2 simple questions for you based on the feedback from this webinar. If you can just quickly in the next 1 minute probably answer those. It was great to have you all in the probably late evening. For those who have attended the previous webinars I have done, this is first time I'm doing that late evening, and it was so heartwarming to see such a good participation over here. The questions have been amazing. I mean, Akshay can agree or disagree about the kind of questions we received, but I think it was a great learning session for all.
Thank you very much, everyone. Really pleasure talking to all of you.
Guys, just 10 more seconds and then we'll close this poll. I'll share the results as well. I mean, no, this is just a feedback form, so it's okay. 10 more seconds. Cool. Okay. Thanks a lot, guys. Thanks a lot for attending. We'll see you with more such webinars with more information from Akshay around these AI driven and what all things have been changing over the time. So see you soon back. Okay. Thank you so much.